Ever wondered when the next housing market crash might occur? It's a question that's been on the minds of many, especially those with a keen interest in real estate and the economy. From past fluctuations to the present-day situation, and even a peek into the crystal ball of the future, the housing market is a fascinating labyrinth of trends, patterns, and predictions. Will there be a crash, or will the market continue to soar? These are questions we'll attempt to unravel. So fasten your seatbelts and join us as we delve into the intriguing world of the housing market. If you're enjoying our exploration into the real estate world, don't forget to hit that like button and subscribe to our channel for more insightful videos. Rewinding the clock, let's revisit the housing market situation a year ago. The tail end of 2022 was characterized by a significant slowdown in home growth. A cloud of uncertainty hung over homeowners and potential buyers as they grappled with the fear of higher interest rates. This apprehension almost brought the growth of home values to a standstill. However, as the year turned, the housing market began to pick up the pace. The following year saw a dramatic increase in home values, a stark contrast to the sluggish growth witnessed at the end of 2022. This shift was a reaction to the fears of the previous year, as the market bounced back with renewed vigor. Now, let's delve into the interest rates that homeowners were dealing with. According to a report by Goldman Sachs, nearly all homeowners, a whopping 99%, had an interest rate that was lower than what was currently being offered on the market. To put this into perspective, 85% of these rates were well below 5%, and 63% fell between 2.5 to 4%. Consider a homeowner with a 3% mortgage. For the monthly payment on their home to match the current rates of 7%, prices would have to drop by a staggering 36%. This illustrates the significant impact that interest rates can have on housing market dynamics. A year ago, the housing market was in a very different state. It was a time of trepidation due to rising interest rates, but it was also a time of resilience as the market rebounded in the face of uncertainty. This journey from the past to the present provides valuable insights into the complex dynamics of the housing market. Fast forward to now, the housing market is facing a significant challenge. We're witnessing a shortage of homes for sale, a predicament that's causing quite the stir. Goldman Sachs reported that a staggering 99% of homeowners have an interest rate below what's currently being offered on the market. Imagine, if you will, a homeowner with a 3% mortgage. In order for that identical home to have the same monthly payment as today's current rates of 7%, prices would have to plummet by 36%. Quite a drop, isn't it? Now let's talk about new constructions. They've been popping up, but not nearly fast enough to meet demand. These new builds now make up 1/3 of the total market inventory. To give that some context, they accounted for just 13% in the years spanning from 2000 to 2019. A significant increase, but still falling short of the mark. Here's an interesting tidbit. In August of 2023, Warren Buffett, the Oracle of Omaha, announced a sizable investment in 3 major U.S. home builders, Dr. Horton, Lennar, and NVR. This investment, worth around $800 million, saw impressive returns. In just 7 months, Dr. Horton's value increased by 35%, Lennar by 30%, and NVR by 20%. That's a cool $250 million in profit for Buffett, but then he cashed out. Some argue that home builder stocks have rallied faster than expected, prompting Buffett to lock in his profits. Others, however, see this as a sign that he's bearish on the housing market, a potential red flag for the future. The housing landscape today presents both opportunities and challenges. The shortage of homes and the surge in new constructions are shaping the market in new and interesting ways. But with figures like Warren Buffett making unpredictable moves, it's clear that the housing market is anything but stable. As we navigate these uncertain waters, we must keep a keen eye on shifts and trends, ready to adapt to whatever the future may bring. But what about the bear case for home prices? Let's delve into this a bit. The blog A Wealth of Common Sense offers some valuable insights into this scenario. They argue that if a recession hits, the impact on the housing market might not be as severe as some predict. A lot of homeowners are locked into low-rate mortgages. If the economy takes a downturn, they're unlikely to sell, particularly as selling would mean taking on a new higher interest loan. In addition, around 40% of homeowners don't even have a mortgage. They're sitting in a comfortable position, without the pressure of monthly repayments. This suggests that we probably won't see a flood of panicked sellers rushing to offload their properties, even if the economy starts to wobble. Now, consider the analysis from Mark Woodworth back in 2023. He pointed out that for housing prices to tumble, we'd need to see either a reduction in demand or a surplus of inventory. He argued that we'd need to witness a fall in demand by 50% for housing to align with historic averages. However, he also noted that this seemed unlikely. After all, transaction volume hasn't dipped below 2 million since the early 1980s. So, while there are certainly bearish factors to consider, it's essential to keep them in perspective. The housing market is complex and influenced by a multitude of factors, not least the state of the larger economy. In the face of a potential recession, the housing market could react in unexpected ways. Now, let's gaze into the crystal ball and see what the future might hold for the housing market. As we step into the years 2024 and 2025, we turn our attention to the predictions of esteemed financial services firm Morgan Stanley. They've presented us with a bull case, a scenario where the housing market continues to climb. Their analysis suggests that housing prices could rise by an additional 5%. That may not seem like a lot, but when you consider the exponential growth of the past few years, it's a significant increase. Morgan Stanley's outlook is based on a number of factors. For one, they're looking at the current housing statistics, which are hitting levels unseen for several decades. Stats like these aren't just interesting, they're a sign that the housing market is evolving in ways we haven't quite seen before. But it's not just about the numbers. Morgan Stanley also takes into account the broader economic context. Their bull case is predicated on the assumption that the US economy will avoid a recession in the coming years. This means a stable or even growing economy could provide a solid foundation for the housing market, keeping it buoyant. Moreover, they foresee the housing market picking up as incomes rise. More money in people's pockets means more potential homeowners, which could fuel demand and drive up prices. And let's not forget the role of mortgage rates. If rates remain favorable, they could continue to spur on the housing market, making homeownership more achievable for many. However, it's important to remember that these are predictions, not certainties. There are many variables at play, and the future of the housing market, like much else, remains uncertain. We can analyze trends and make educated guesses, but we can't predict the future with absolute certainty. In the end, what we can be sure of is that the housing market is never static. It's a dynamic, ever-changing entity that's influenced by a myriad of factors, from economic conditions to consumer behavior, from interest rates to housing policies. As we move forward, the housing market continues to be an intriguing space, full of possibilities and uncertainties. So, we've taken a journey through time, examining the housing market. We've revisited the past, where home values hit a low just about a year ago, and interest rates on mortgages were enticingly low. We've seen how homeowners, enjoying the benefits of these low rates, would need to see a significant drop in prices to consider moving, creating a shortage of homes for sale. We've navigated through the present, where new constructions are struggling to keep pace with demand, contributing to just a third of market inventory. We've also looked at investment trends like Warren Buffett's strategic moves in the housing market, cashing out on the rise of major US home builders like Dieter Horton, Lennar, and NVR. Then, we've peered into the future, considering both the bear case and bullish predictions. We've learned that despite the potential for a recession, many homeowners, locked into low-rate mortgages or mortgage-free, are unlikely to sell. Therefore, a dramatic drop in prices due to a surge in inventory is improbable. We've also considered the alternative, where housing prices could rise by another 5% according to Morgan Stanley's bullish scenario. This outlook is based on the assumption of a strong economy and increasing incomes, leading to a revived housing market. While the future of the housing market remains uncertain, one thing is clear: it's a fascinating field that continues to captivate us all.